Should the new temporary senior tax deduction change your Roth conversion strategy? Joe and Big Al spitball for Chris in Maple Grove, Minnesota, who wonders whether to keep converting to Roth now that the $6,000 senior bonus deduction phases out with higher income. That's today on Your Money, Your Wealth podcast number 554. Teri from Salt Lake City's broker has amassed $60,000 of losses in Teri's $1.1 million account due to tax loss harvesting. When is enough enough? Windy Chicago in Chino Hills, California, wonders what to do about their cost basis vanishing after transferring mutual funds to Vanguard. And Larry and Sally from Michigan are planning for retirement while facing significant health challenges. Can they afford to bridge the healthcare gap and still retire safely? I'm executive producer Andy Last, and here are the hosts of Your Money, Your Wealth, the other two-thirds of JABA, Joy Anderson, CFP, and Big Al Clopine, CPA.
Let's kick it off, Big Al.
Okay, love to.
In Maple Grove, Minnesota. You know, Maple Grove is where Ruthie lives.
Oh, is that right? Okay,
that is correct.
So this is kind of near and dear to your heart then.
Oh, I bet they're neighbors.
Yeah, probably, yeah.
Yeah, right around the same age.
They sure are.
All right, let's see what they got here.
Okay.
All right, I'm 73, wife 70. This is my first year of RMDs. I have been doing Roth conversions up to the first IRMA bracket for many years. This now turns out to be higher than the $150,000 income limit the OBBB placed. You know what that stands for?
OBBB.
I believe that's one big, beautiful bill.
That is one big, beautiful bill.
Okay, there you go. I didn't know that, so learned something today.
Okay. I'm looking for guidance on how to evaluate the benefit of doing a Roth conversion up to the first IRMA tier versus stopping the Roth conversion at the initial OBB limit. I realize the $6,000 per person exemption decreases from $150,000 to $250,000. Our main reason to do Roth conversion is to give our children and grandchildren tax-free inheritance and make sure our future RMDs of a solo survivor won't be too high. For reference, my current IRA is roughly $900,000 and my wife's $260,000. Our current Roth IRAs combined are $1.4 million. Our pensions and Social Security provide about $10,000 per month, which cover our expenses. It puts us in the 22% tax bracket before the RMDs. I hope this gives you basic information you need to help me evaluate this new wrinkle in the tax code. Thank you. Hi, Andy. In regards to our other assets, we have about $200,000 in a brokerage account, $100,000 in cash. Our house is paid for, worth $950,000. If you have any other questions, feel free. All right. So he's looking at the $6,000 credit that will kick in with $150,000 to $250,000 of income. So it's putting a little wrinkle in his in his conversion strategy. So if he goes too high, he's going to phase out of the, I guess, personal exemption.
Yeah, so maybe let's explain what it is. It's the senior bonus deduction, and it's for 2025 through 2028. So it's for the next 4 years, $6,000 if you're 65 and older. And Joe, it doesn't matter whether you itemize or not. You still get to take that $6,000 if your income is low enough.
So it's a deduction, not a credit.
It's a deduction, not a credit. That's right, deduction. And so if you're single, it starts phasing out at $75,000 of taxable income, and fully phases out at $175,000. For married, it's $150,000 to $250,000. So in either case, Joe, it's about $100,000 phase out. It works out to about for every dollar of extra income, you would lose 6 cents on this deduction. Is maybe a way to think about it.
Yeah, or another way to think of it, and tell me if I'm right or wrong here. So let's say 150 to 250. So if he had $200,000 of taxable income, he would only receive $3,000 of the exemption.
That's correct.
He would lose half of it.
He'd lose half. So in terms of a percentage, that's a 6% percentage, right? So if you're trying to think about what's the extra tax, it's 6% if you're in that phase out range. But I will say there's another wrinkle that makes this even more complicated, and that is for the IRMA for 2025, it's your income in 2023, right? Which already happened. And for 2026, it's your IRMA in 2024, which already happened. So if you're really talking about planning, you only have 2 years that this makes any difference at all, 2025, 2026. So if you're trying to preserve the whole $6,000 of deduction, you might want to stay under as a married 150,000, single 75,000. But like I say, it's only going to help you for 2027 and 2028, unless they extend it, which they could. But that's how the law is written right now. It's temporary. It goes away at the end of 2028.
But all right, looking at his asset base, I mean, he's already got a ton of money in Roth.
Yeah.
So let's call it $1.2 million. What's his RMD is going to be 45, 50 grand?
Yeah, that's about right. Yep.
So $50,000. His taxable income is 120, roughly. It's probably less than that. So his gross income, he said $10,000 a month with Social Security and his pension.
Yep.
So that's 120 minus 30. So I don't know. He's at $90,000 roughly of taxable income. So he could still do a conversion.
He could, but I think he's 73. So his RMD probably will hit this year.
Oh, yeah. So
Yeah.
his RMD is going to hit at $900,000. So 30,000 is going to be his RMD. He still has about $20,000 of room to stay below that 150 potentially.
I agree. There's a little bit of room, but just, yeah, if it were me, Joe, I would try to stay under the 150 because that's a pretty good deduction, that $6,000.
Yeah, for sure. And I don't think he's ever going to be higher than the 22% tax bracket unless the 22 goes back to 25.
Sure.
That's the only risk, and that's a speculation. So
Right.
I would stay under the 150 as well. I think he's done already a phenomenal job of getting a lot of money over to the Roth IRA. 900,000 is still a pretty good chunk of change of income that he doesn't necessarily need, that he has to pay tax on. I do like the 22% tax bracket, but stay below the 150. Or if he goes a little bit higher, it's not going to kill him. But that's the OBBB little wrinkle.
One big beautiful bill. Okay, now I know it.
All right. Well, cool. All right. Maple Grove. Wonder whereabouts he lives. Maple Grove's a pretty big city.
Is it? Okay. I don't know it.
Yeah, it's nice.
I'm sure.
Very nice. Yeah.
It's especially in the summer, huh?
Yeah, it's very nice in the summer. All right, cool. Let's go to windy Chicago in what? Windy Chicago.
They're
in
calling
Chino
themselves
Hills.
Windy Chicago, and they live in Chino Hills, California.
Yeah, that's okay. Maybe they're from Chicago.
But they live in Chino Hills.
Yep.
Correct. Yeah.
All right. I did an in-kind transfer to Vanguard of some mutual funds that we owned for quite a while. However, the cost information wasn't transferred to Vanguard. Now, when we look at the unrealized gain lost, there aren't any. Will this be reported on my 1099 when we sell these funds?
Great question. So I guess the first thing you can do is you can contact Vanguard and send them your cost basis information. They will generally put that in for you. But if you don't want to, or they don't do it for some reason, it's no big deal. There's lots of cases where your brokerage house doesn't know the cost basis. And there's three choices on the 1099, Joe. The first choice is the brokerage house has the sales price and the cost basis. The second choice is they have they have the sales price, but not the cost basis, which would be the case here. And the third case is they don't have either the sales price or the cost basis, but they're letting you know that something happened. So at any rate, yeah, it's no big deal. You just, if it doesn't get in the brokerage company, you just enter it on the tax return yourself. And remember, income taxes are on the honor system. So
honor system.
That's
honor system.
And I'm sure you all out there have high integrity, so I'm counting on you.
A retirement strategy is like a basketball game. You want every single shot you take to be nothing but net, but sometimes you need a retirement rebound. This week on Your Money, Your Wealth TV, Joe and Big Al show you how 5 plays can help you turn things around, get that rebound, and score a comeback. Click or tap the link in the episode description to watch it now. Plus, after a lifetime of saving, making the transition to retirement means facing a whole new set of challenges. How are you going to generate income in retirement? Download the Retirement Income Strategies Guide for 5 questions you need to ask yourself before you retire, the sources of income available for you in retirement, how to maximize your Social Security benefits, and how to develop a retirement income strategy that meets your needs. Click or tap the links in the episode description to watch Retirement Rebound on YMYW TV and to download the Retirement Income Strategies Guide for free.
Let's go to Teri from Salt Lake City. My broker continues to amass losses due to tax loss harvesting. I struggle to see how this is a good thing. It just amasses losses. All right.
Yeah, right.
At what point is this too much? Presently sitting at a $60,000 of loss on a $1.1 million account. What am I missing? He explains for future use, but I feel I'm missing current year opportunities. Any help explaining rationale would be appreciated. YMYW, the best. All right, Teri. All right, let's see. She's got $2.2 million in tax-deferred accounts. Tax-free is about $1 million. Taxable account, $1.2 million. Pensions is $95,000 a year. Social Security is $105,000. I'm 66. Spouse is 65. Retired. Living expenses, $72,000. Thanks for asking. Didn't think it was applicable, but I'll take whatever insight I can get. Beverage choice, ice cold Corona.
That's another case where somebody replied to the email that they get after submitting a spitball request, asking, "Are you sure that you gave us all the information needed for a spitball?" Got
it. Most importantly, what you're drinking. And you know what? An ice cold Corona sounds pretty good to me right now, Joe. I'm in Hawaii. It's 81 degrees. I would take one.
Yeah, you look like you got a little sun too.
I got a little too much, so I'll try to tone it down next couple of days.
All right. Tax loss harvesting. So presently sitting at $60,000 of loss on a $1.1 million account. Is this a good thing, Al?
It's a great thing. Let me explain. I mean, if
it's good and bad in a sense.
If they're doing it right, it's a good thing. I'll put it that way. So here's what I mean. Here's what I mean by that. So in your brokerage account, non-retirement account, you're going to have certain mutual funds or stocks or ETFs that go up and certain ones that go down. And when they go down, it's a great strategy to sell them at a loss. But here's the caveat. You need to buy something very similar so you're still in the market. So you're not missing out on opportunities. You're still in the market when the market comes back for that asset class or that sector or whatever it may be. You will enjoy that increase. But in the meantime, you've created a tax loss, which you can't necessarily use unless you have tax gains. But think about this. They never go away. They carry over year after year after year for the rest of your life, which means in this particular case, Teri, the first $60,000 of gains in your account is tax-free. It's a great thing. And probably, I don't know your advisor, but chances are they're buying something similar, so you're still in the market. So yeah, I would like to have as many as I could. Yeah, I don't like to lose money, but that's the nature of investing. So that's what I would say.
I wonder if this is like in the past year, the past month, the past week, right? $60,000. So if you take a look at the markets this year, I wonder.
I don't think it'd be this year. Probably
most of them are up.
Yeah. If it's this year, maybe you got the wrong investments. We'll put it that way.
Yeah, that's the point. It's like, well, if they're harvesting a bunch of losses in up markets,
yeah, that feels bad.
What's the investment strategy? You know, you don't want to buy dogs to take advantage of taxes.
True. Well, that's a good point. I guess I should have prefaced with assuming you have the right portfolio for you. We'll start that way, huh?
But you're right. Let's say if you have several different asset classes, small, international, emerging markets, U.S., whatever, you know, they don't all move in the same direction every year. Some go up, some go a little bit down. That's the beauty of diversification. And so when you have dollars in a brokerage account, so we talk about asset location. In asset location means, well, you want to have certain asset classes in certain accounts depending on how they're taxed. So in her situation, they have $1.1 million in a brokerage account. They have a couple $1 million in a retirement account that's tax deferred. And then they have another $1 million in a tax free account. So when you think about an overall asset allocation and an asset location strategy, is that in the taxable account, the brokerage account, that's where you want to keep more stock or stock mutual funds or stock ETFs. Your Roth account is where you want to keep more stocks, and where you want to keep more safety, like bonds, CDs, cash, would be more in the tax deferred account. And the reason why you want to have more volatile asset classes in your taxable account is because of the tax loss harvesting. You can harvest the losses and create tax-free income as you utilize the strategy appropriately. And also, if you have high flyers in there that make 10, 12, 20% gains, I'd much rather be taxed at a capital gains rate than I would be at ordinary income if they were sitting inside my IRA. So it sounds like your broker is doing a great job. Unless he's buying or she's buying, I don't know what they're buying. If you're harvesting $60,000 a loss a month, that's probably not the best strategy.
It may not be. So here's one more thing I want to say. When you've got these losses, they're capital losses. They can be used against any capital gain. I think a lot of people don't realize a stock loss, a capital loss that carries forward on your tax return. You can use that against a real estate gain. You sell your home, you have more gain than the exclusion. You can use it against a home sale gain or a rental property gain. These losses are pretty valuable. So yes, you want to have the right investment strategy, but assuming you do, if certain asset classes go down, you want to sell them, buy something similar, harvest those losses so you can use them against future gains. And that's super valuable, I would say.
Yep. I think some other confusion when it comes to capital losses is that if you don't have any capital gains to offset the loss, then you're able to write $3,000 of the $60,000 in that given year. So sometimes people will say, "Well, I got $60,000 of losses and I can only write $3,000 off. It's going to take me several years. It's going to take my lifetime to utilize these losses." I mean, isn't enough already?
Yeah, that's a good point, because a lot of people do think that I only get $3,000 a year. What's the point? Well, the point is you get to deduct your losses dollar for dollar against capital gains and take another $3,000 per year against ordinary income. So it's pretty helpful. Here's another misconception, Joe. I've got this capital loss at short term, but my broker sold a long-term gain. I can't use the two against each other. Yes, you can. Yes, you can. It's true that short-term losses go against short-term gains first. Long-term losses go against long-term gains first. But then if there's still extra losses, they go against the other one that didn't have enough losses. So it's actually a good thing, is presuming you've got the right investment strategy.
Get an idea of how long your money will last in retirement with our self-guided financial blueprint tool. It provides personalized insights, identifies potential shortfalls, and suggests actionable steps to help you secure your retirement future. Once you're armed with the information you need, consider meeting with the experienced professionals on Joe and Big Al's team at Pure Financial Advisors for a free financial assessment, either in person or from the comfort of your own home via Zoom. The financial blueprint and the human assessment are both free, with the goal of educating and empowering you. The Pure team will help you develop a thorough financial plan that goes beyond the basics, offering guidance that addresses both your unique immediate needs and your long-term retirement vision. At the end of the assessment process, you can decide whether becoming a Pure client can add value to your financial life and what those next steps look like. Get your financial blueprint and learn more about the free assessment process. Click or tap the links in the episode description to get started.
All right. Hey, Joe, Al, Big Al. Or I guess that makes you folks. Jabba the Hutt.
Joe, Andy, Big Al, Jabba.
Oh, Jabba.
Will, the gas siphoner, actually pointed that out a while back as well. So apparently Jabba is our acronym.
Got it.
Yeah.
Okay. Yeah.
Okay. Yeah. Jabba.
It's not
Jabba?
Not a super flattering reference, but that's okay.
Love Jabba the Hutt. Let's see. Okay, this is Larry and Sally Morgan from Michigan. Bonus points for getting the reference without using the internet. Larry and Sally Morgan from Michigan. No clue.
I will admit I did actually use the internet for this, and Larry and Sally Morgan are the main characters in a book called Crossing to Safety, a 1987 semi-autobiographical novel by Pulitzer Prize-winning author Wallace Stegner. I don't think any of us would have gotten that without the internet. I'm not sure how many of our listeners and viewers would have gotten that without the internet.
Who's Wallace Stegner?
He won a Pulitzer Prize.
Crossing to Safety.
Yep.
Yeah, I would say if it's going to be like a book reference of 40 years ago, we have
Charlie Brown.
Well, maybe that one, but otherwise we got about a 1% chance of knowing what it is.
I think that's high.
You're probably right.
Yeah, I don't know.
I would know Charlie Brown, Charles Schultz. I'd get that one.
Yeah, the only books I know is like Curious George.
Yeah, if it said Linus and Lucy or something, you'd get that.
Yeah.
I got Dr. Seuss down. Theodore Geisel. I got that one.
All right. Or S.E. Hutton. Who's that? Anyone?
No. See, I'm
not related to E.F. Hutton.
I only get 1 out of 100 right on this. So.
Got it. Remember when we used to play the theme songs to like 1980s and 90s TV shows?
Yeah, that was fun.
Then, I think you got maybe 10% of them.
Oh, I think 5%. Yeah, that's not my. I mean, you have to play like something I know, like Gilligan's Island, for example.
That was it. I think those were the only ones. But we played like Taxi, Hill Street Blues. We had like
and you probably
Cheers.
Well, I knew Cheers.
Okay.
Of course, I knew Cheers. But like Hill Street Blues, I would have known the song, but I may not have in that moment thought of it quickly enough.
Got it. No.
I have a hard time with anything that's an instrumental. I'll be like, yes, I know that perfectly. What is it? I have no idea.
We should start doing it and trying to stump Joe.
Oh, it would be pretty tough.
We can.
If there's like movies, but like that, the TNT TBS days.
Yeah.
So the ones that were just constantly on.
Yeah. Them.
Oh, I would know them. Give me 10 seconds or 5 seconds. I would be able to know the movie before like even the credits were going.
Got it. Okay. All right.
So that's a little. Yeah, I'm embarrassed to admit that's a talent of mine. So
watch a lot of TV when you're younger.
I like movies, Alan. I'm a big movie guy.
Got it. Okay.
So,
and you remember them all.
Yeah, well, I didn't have HBO. Back in the day, if they were on normal cable, that was your HBO, that was your Cinemax, that was the Showtimes. So
you watch a movie, you remember the name of the movie, who was in the movie, what the plot was, what some of the lines were, and I've already seen the movie. I can't even remember if I saw it or not.
I'll see it in a half an hour after it's over. I've forgotten everything. That is just not necessary to keep in my brain. I've got too much other stuff up there.
Yeah, I think I'm in that camp, Andy.
Yeah, I'm a big movie guy.
Yeah,
so
that's good. You got a great memory too. So keep it up.
Oh, sharp as
and you retain all that along with the Roth conversion information.
I do. It's getting too full lately. I can tell that. I gotta brush it up. Anyway, all right. We're looking for a spitball here. Analysis of our ability to retire. All right. Currently making about $300,000 per year, but that has only been for the last 2 years. Prior to that, our income was about $170,000 with our employer match. We save about 30% of our income into our retirement each year. Our current savings are $590,000 in a 403B, $465,000 in an employer contribution supplemental tax deferred account, $40,000 in a 457, $152,000 in a Roth IRA, $102,000 in another Roth IRA, $110,000 in a brokerage account, $680,000 in a second brokerage account. My God, how many accounts do you have?
Wait, there's more.
Yes, $560,000 in a third brokerage account. This guy loves mail.
He does.
I mean, how much stuff comes into his mailbox? Here's a brokerage account statement. Here's another one. You place a transaction in any of these things, it just gets flooded. Confirmations up the yin yang.
That's right. If you're trying to keep track, it's about 2.8 million.
He doesn't like consolidation.
No,
He likes to have lots of different accounts, lots of
he
different.
he wants to see if I know how to add. So I think he's giving me a little test here.
All right. On top of that, we have about $100,000 in cash in CDs across all our accounts. We have about 13% guaranteed, 61% equities, 4% real estate, 21% bonds, and 1% in a money market. You think this guy has spreadsheets?
I think so.
Oh,
He's
Wow, and
got
I just
Excel.
realized the recap that I give at the beginning, I just started adding it all up, and then apparently I just gave up. That's completely out of date.
Yeah, you did. I noticed that. Well, and at least he rounds to the nearest thousand, so that's
Thank
good.
goodness.
yeah. We have no debt. A house property worth about $700,000. A cabin worth $65,000. I drive a 2021 Jeep, a 2020 Explorer, and have a 20. You drive both? And a 2016 GMC pickup that's a beater truck for things we take to the cabin. Our only source of fixed income will be our Social Security, which will be about $45,000 per year for me and about $26,500 for my wife at her full retirement age. We'd like to hold off on claiming Social Security until 70, which would put us to about $57,000, and are open as to when would be the best for my wife to start claiming. Our annual spending is about $95,000 currently, and would like to keep it near that at our retirement. But we do want to have 2 to 3 bucket list vacations, which will probably cost about $60,000 each in the next 6 years. My wife is 60 and I'm 58, and we're looking to retire in 2 years. All right. That leaves us with a 5-year Medicare gap for me and a 3-year Medigap for my wife. I can use Cobra for the first 18 months of that gap, but then would have to head to the ACA. I'm assuming the 8.5% rule will last prior to my retirement, so going Cobra will cost us about 22. Will cost us about $22,000 and $5,000 per year. This is not included in the above annual spend. While our silver plan, California estimate, is about $32,000 per year. One question I have is, can I get our ACA costs down or increase the subsidy by drawing retirement spending prior to Medicare from our brokerage account and claiming capital gains to minimize the MAGI? Yes, that's all about retirement income strategy and planning. It's
Yep.
you don't
Agreed.
they're not going to look at you have 400 different accounts.
Or that you have
You
2.8
should be
million.
you should be penalized by having several hundred accounts.
Right.
But no, you're not going to be penalized for how many accounts that you have, and you're not going to be penalized for how many assets that you have. What they're going to look at is how much income is drawn from the overall accounts or how much is generated from the accounts that land on the 1040.
That's all they look at. That's right.
So if you have a tax efficient strategy of pulling dollars, you would have very large subsidies.
Okay.
The other wrinkle in the plan is I have an incurable brain disease. Oh boy, sorry to hear that. Which, while not fatal, progress at a random rate for each person, making difficult to plan. All right. But it will likely remove my ability to eventually function on my own. And so that necessitates the long-term care, hence the time frame for the bucket list trips. So the big question is, can we cross safely into the retirement and enjoy drinking our California Cabernets and peated scotch on our deck 2 years from now? Yeah, let's see. A couple $1,000,000. You got to bridge the gap to Social Security. He wants to spend $100,000. I think he's sitting in pretty good shape.
He's in great shape. Let me go through the more formal math. So he's got 2.8 million. He's adding about 90,000 a year. He says 30% with the employer match on 300,000. So 90,000 a year. He wants to work 2 more years. I just did 6%. I get 3,150,000. Okay. He wants to go on 2 to 3 bucket list trips, 60,000 each. So I said, well, how about 2.5? So that's 150,000. Let's end up with an even 3 million. What does that do? At age 60 or 62, whatever, I think 3.5% is a pretty safe distribution rate in general. 3.5% of 3.5 million is 105. He needs 95. I know there might be a little extra for insurance, but That's before Social Security. Yeah, I'm thinking this looks fine, and I would definitely execute on that plan, particularly depending upon your disease. Make sure you certainly enjoy the time you have. Hopefully, it's a lot of time, but yeah, make sure you enjoy it as soon as you can. That's what I think this looks fine, Joe.
Yeah, he's got a plan for long-term care.
It
There's
does.
going to be, and I'm not sure if he has insurance, and he's probably uninsurable at this point.
He'd probably be uninsurable. They've got the house and the cabin. I'm not saying that's first choice to sell those, but they've got those assets as well.
Yeah, I think he's sitting really good. He's done a really good job saving, and he's plowing a lot of money into the overall accounts as well. Um, at $100,000, you got to bridge a 6 to 8 year gap, for Social
Hmm.
Security. So let's say $100,000 over, 10 years. I mean, he's still, let's say if he has zero growth in the overall accounts, it still looks really good.
Yeah, when you add the Social Security on top of it. Yeah, I
Yeah.
agree. Yeah,
So,
yeah,
so 100,000 at 10. Let's say he just stayed in CDs. He's got
right.
$3 million. He spends
Yep.
100. You take all the money out. He still has $2 million at age 70. He's got roughly $60,000 of Social Security. He needs
Right.
$50,000 to draw from. He needs
Yep.
1.2, $1.3 million at age 70. He's going to have probably well over two, just depending on the
Hmm.
growth of the overall accounts. It's
Yep.
the sequence of return risk is it gets a little dicey. The long-term care stay of how much he really needs to be thinking about in regards to side cash to help pay for that care. Because basically, if he needs around the clock care, his wife won't be able to do that. You know what I mean?
Sure.
And I'm sure
Of
he
course.
wouldn't want to put his wife through that. So you probably have to have some in-home care, things like that. And that stuff isn't cheap.
No,
That's adding another $95,000, $100,000 on top of the $100,000 living expense. So
hmm
I would want to be running some of those different scenarios and different numbers just to make sure that just kind of put a bow on this thing and for best case, worst case type of
Yeah.
scenarios. But I'm with you. I would retire if 2 years is the mark. I would punch, go on those bucket trips, have a
Yep.
blast,
Yep.
because I think he's got a lot of really good things covered. So,
Yeah. Drink that wine, drink that scotch, have a great time.
I would double fist every day.
Oh, I know you would.
You said you don't already.
I'd be on that deck. I'd be with him.
Yeah,
Be
there you
hanging
go.
out with Larry,
All
drinking
right.
some scotch and some wine. I don't drink wine or scotch, but I would start.
You'd start. Yeah.
Sure. Hanging
I
out
would-
with Larry?
I'd
Fun.
hang out. I'd hang out too. I'd do it too. Why not?
Yeah, you show me his spreadsheets. Yeah, he probably has just a stack of old statements from
Probably.
the 80s.
Yeah,
I
probably.
could just see this guy's. I mean, he probably saves every document. He's got tax returns from when he was 12.
He can give you the Cliff's Notes version of the Pulitzer Prize winning book that his name is from.
Yes, we could talk about really good books.
Yeah, that's right. That'd be a short conversation.
Oh my God, you would probably have to get wasted.
Yeah, probably.
All right, cool. Al, enjoy your time in Hawaii. Cut this
Thank
one
you.
a little short. But yeah, we got a few done. So call it a day.
All right. Sounds good. Thanks, guys.
All right. Thank you, Andy. Thanks, Al. We'll see you guys next week. Show's called Your Money, Your Wealth.
Next week on Your Money, Your Wealth, Christine wants to know the best withdrawal strategy before claiming Social Security at age 62. Prickly Richard and Margarita Maggie from Tucson are trying to avoid an RMD avalanche by doing Roth conversions. And Michigan Queen and Mississippi Boy from Tennessee are deciding between saving for retirement at age 55 or saving for their kids' future. Now, if today's episode helped you to rethink your Roth plan or your tax moves, make sure you're subscribed to the Your Money, Your Wealth podcast and our YouTube channel so you don't miss what's next. Share the show with a friend or a family member who's navigating new tax rules. And don't forget to click or tap the free financial assessment link in the episode description to schedule that one-on-one comprehensive assessment with Pure Financial Advisors. They'll help you get your Roth conversion, your tax strategy, and your retirement plan all working together. Pure Financial Advisors is a registered investment advisor. This show does not intend to provide personalized investment advice through this podcast and does not represent that the securities or services discussed are suitable for any investor. As rules and regulations change, podcast content may become outdated. Investors are advised not to rely on any information contained in the podcast in the process of making a full and informed investment decision.